Yeah, thank you very much, Sergey. It's great to be here. My presentation today is really to encourage people to get more involved in insurance. It's quite a boring topic, naturally, because of various reasons, which hopefully by the end of the presentation you might be a little bit more inspired. And the reason for that is we don't often realise, but we're all connected through insurance, whether it's through personal insurance or business insurance. And just to give you some perspective, it's an $8 trillion premium marketplace with assets of around 30 trillion, and that's growing every year. It's very much linked to the gross domestic product increase. It affects us in all ways, social interactions, travelling, weather patterns. There's an interconnectedness to it. At the moment, it's quite fragmented. I've been fortunate enough in my career to have started in the industry at a very sort of strategic level, very much focused on alternative risk finance and alternative risk transfer product. It's a sort of macro level capital planning more than anything. I'm a chartered accountant by profession, so I spent a lot of time looking at processes, procedures, risk, compliance, regulatory applications, capital planning, and explaining very complex transactions to senior leaders. And that involves very different disciplines, quantitative modelling, actuarial science, and also sort of more softer side of risk, decision making. So I'm very pleased to present to you, and thanks Sergey to have met here and the team here. I left my job about 5 years ago. I had a pretty good job and a young child, a young daughter. Some people said I was stupid or brave. I think I wonder sometimes, it's not so smart, but 5 years ago I knew something was wrong with the insurance industry, fraud, fragmentation. And I went on a journey, obviously working with the skill I have independently, and I began to evaluate, research a lot more in depth, because quite honestly, you don't have time when you start working in a professional job. So I would encourage you all to spend as much time as you can now learning and talking to people and trying to get an understanding of the practical application of your studies. Because once you enter into the workforce, so to speak, you just simply, there's a lot of stuff you'd love to do, but you can't do it. So a couple of things that we always look a lot further back in history in insurance to try to predict the future. That's sort of some of the principles. So what I often like is looking at these sort of, I guess, eras, you could say, the Enlightenment era. And I'll explain a bit more about the history of insurance. A long time ago, modern day, and what I believe to be the future. I genuinely believe blockchain technology will change many things. I think we're already at the very beginning of scratching the surface on what is possible. I've analysed a lot of cryptocurrencies at the moment. My own personal view is I think there still needs to be the next level of understanding, backed up by a lot of scientific research, which I really, for the last 2 days, I'm very encouraged by what's been going on. So, the current state of the insurance market, the capital is very much at a very top level, macro capital. It's a sort of blended finance level of the globe, if you like. It's more or less synthetic debt at that level. It's not insurance and it's not finance. It's something very different, and that's created. It suffers with an overwhelmingly high level of cost, which is where some of the applications of blockchain to break down those cost layers, because there's so many people involved in the process, from somebody buying a car insurance policy, or a pet insurance policy, or a house insurance policy, or a gadget insurance policy. There's 20, 30 different products that are out there as consumers, and there's a very obvious disconnect between the value. The result, it's unclear pricing. We talk about I know in the exchange market it's about price discovery, but risk discovery, premium discovery, it's only really beginning to take its shape with technology. What I want to do here is give you a visual on how complex this value chain is. And this is a very simplified level. So you get the pointer or the laser? Oh, okay. We'll start from the bottom arm. You can see at the very bottom you have different products, and this is represented by travel, plane, home, motor. So you have in each country, and then you have each region, and then you have a sort of global level. So we start with the first level, the insurance level. And if you look at any stock exchange in any country, you'll see quite high on that stock exchange are financial institutions, insurers being one of them. So they typically sell you, an insurance company will sell you a specialized product. And in one country you may have 4 or 5 different products. But those local insurers, so for example in Dublin, the insurer can't absorb the full amount of risk. And I mean that in the sense of, if you buy a car insurance policy and you have a claim for 500 euros, that's fine. But you could have a claim for 50 million euros. So that you need to be able to offlay that risk. And then you bring in another layer, the reinsurance layer. And what those guys do is insure the insurance companies. And this is the point then, as a consumer, you lose the transparency of that transaction. And there's a sizable cost, not just on administration cost. As an accountant, I spent a lot of time reconciling. On the far side, you have brokerage costs, and they could be 5% at the front level. So we start beginning to see a picture on the inefficiency of this system. The next layer above that, then, a reinsurer will take different products to get diversification. They will themselves buy a reinsurance policy, which is then more geographically diversified, not product diversification. And at that layer then, you've also got a brokerage fee, an agent fee. It's a wholesale fee, it's an insurer, business-to-business fee. And that can be up to 20% of the same capital that's come down to the client. They also have administration costs. They're regulated entities, they've a board of management, they've got CEOs, chief risk officers, chief compliance officers, treasurers, actuaries. You begin to see actually we're all connected in our own way in an inefficient system. And then at the very top level, you have this sort of, it becomes one with a financial product. And these are more like securitized bonds, catastrophe bonds you might be familiar with. Ultra difficult to price, but ultimately you put a big amount of capital aside for the very big events. And we talk about events which I'll show you, natural weather events, hurricanes, very serious events that then affects the pricing on the overall ecosystem. And that drops down then to your car insurance, house insurance, travel insurance, and those things. A quick slide here. I know we are short of time, and I have a lot more interesting stuff to say, but I want people just to realise actually the breakdown. These numbers are sort of representing all the different layers and the different players. So if you look at an insurer, they charge you $100. If they lose $101, they're out of the money, right? So they try to keep within that zone of collecting as much premium that will cover their cost plus a profit. So you look, it's about 60-40, 60% of the actual claim. You've broken your window, you've fallen off your bike. And 40% administration, people, buildings, broker fees, agent fees. If you look at the components of that, then 60% of on that side on the left, 50% of 60% is the pure claim. This is the technical claim. You've got legal expenses if you have a complicated claim, and they're insanely big because they have to go through a lot of court processes. Claims handling, the validation. Have you had a claim? Prove it. Collecting the police certificate, or whatever other reference points. And I think by the end of this, we'll get a sense of why blockchain is so applicable in insurance. because you've got so many different parties in the system. Fraudulent claims is a huge cost for insurers. We like to think of a world where everybody is honest, but unfortunately we don't live in that world. And there's a lot of artificial intelligence now being deployed to try and identify fraudulent activity. They're crazy stories, people driving into each other to claim, pretending they have an injury. So I believe that we can target each one of those buckets with a cost reduction and get that 60-40 split much, much lower to make the system more honest and actually more transparent and give more value to the end user. Just to put the numbers in perspective, the macro capital, this is a slide from Babel, a company Aon which I used to work with, one of the leaders in risk financing and risk consulting. There's about 600 billion of capital set aside for trading, if you like. And as you can see over time, that's increased. To the far right side, at 89, is the influence of alternative capital. At the moment, as everybody's aware, interest rates are pretty low globally, so investors are looking for different diversified risk, and so they're participating now by providing this insurance-linked capital. This slide is from the Insurance Development Forum. Insurance, we've got more data than we know actually what to do with, so if people are really data hungry, it's the industry to be in. This slide shows the natural events and the economic losses. As you can see, actually, many are uninsured. Some people don't buy insurance. We have a couple of spikes in there, particularly around 2011, where you had the Japanese and New Zealand earthquakes. It was one of the largest economic impacts. So what does that mean? That means the quicker you can deploy capital to repair those economies after a natural event, the quicker the economies can come back online, and the quicker people can get on with their lives and go about their daily business. Again, another spike, 2005, Katrina, Wilma, and Rita. Early 2000s, it was a very volatile area for insurers, and they had to change their capital models, and that was the time I was working with Swiss Re at that time, because they had a low interest rate environment, so they didn't get any investment return. They had the World Trade Center events, natural catastrophes around that, so it's like a combination of events. So they changed the capital models to bring in more of this longer-term insurance-linked securities. For reference, after these are a couple of the very large catastrophe events in insurance. Why does it affect you? Because it trickles back down. Because if you lose that amount of money at the top level, you have to recover that over time at the lower levels. That's why your premium for cars go up. Digitization hasn't really hit the insurance industry. There's a lot of apps out there, but the back end is still very traditional. The back end risk financing hasn't changed. But we're moving to a fully digital world, so you've got a lot of emerging economies now getting access to this capital. A couple of other reference points about performance. You look at the performance of the insurance market is pretty stable in comparison to banking. It survived the financial crisis. Ironically, because they put a lot of money into the financial institutions, it was quite lucky they didn't suffer too much. AIG, the big American banks, bailed out because they began to underwrite these complex financial transactions, which nobody really knew what risk they were taking on board. So if AIG had failed, that would have had a knock-on effect to the banks. It would have a contagion effect. The point I want to make on this slide is a customer doesn't see the investment return. So you pay your premium on day one, and that's actually renewed in 12 months' time. It's because it's a very static kind of industry. You take a picture at the end of the year, and then you move to the next year. Rather, what I'm trying to create is a more of a film aspect, that it's a continually moving target. The outlook, growth is huge in developing nations. India, Southeast Asia. Europe, US is very flat. We don't have much growth. But it hasn't always been this way. If I was standing here 8,000 years ago, talking what I would talk to you about, I probably would get stoned. I'm not stoned in that sense. But insurance is pretty old, so shipping on Babylonian times, they would move cargo. So this concept called bottomry loans, which is effectively a catastrophe bond. It's saying you're going to take this cargo, you're going to take this ship, you might not come back. So they put up a capital, and if you do come back with the goods, you pay a premium for that and you return the capital back. So sort of, in some ways, 8,000 years later, we haven't really changed that concept of catastrophe risk. Benevolent societies in Roman times, it was if you suffered, you were injured, or you died, they would look after your family. In that sense, that's another sort of mutualization of insurance. The modern day evolution, then I'm British, so I'm obviously biased on the history of modern insurance. But it really began to take off sort of around the 1660s. We had a great fire in London, in an area in the city of London called Pudding Lane. Why that's funny is they baked cakes and bread in a particular lane in the city, but the density of the city and the way the buildings were made, it was very combustible. So what happened is they had a great fire of London, and it really killed the whole area. So one of the guys, Christopher Wren, he was at the time quite a leading light in that era, designing cities and this new way of thinking. He redesigned the city of London. And what he did was, like many at that time were kind of cheeky, he designed a monument in place of where the fire took place as a reference. And that monument actually was designed as a telescope. Not many people know this. If you are in London, you should go to the monument, and you might be able to see that. So since then, there's been a lot of natural catastrophe events, the San Francisco earthquake, to name a few, and that changed then into the modern day evolution of Lloyd's of London. So that system is changing very rapidly. So I'm going to talk to you now over the next few slides about some of the initiatives that are going on in the insurtech and fintech space. I think in the future we'll have greater settlement times, more transparency of data, better information and credible information to work with. That's where I think the blockchain has a lot of value, so that as an analyst you've got data that you can rely upon. And if you imagine those 4 different layers, trying to work the data through those layers, and we're talking here, maybe tens of thousands of insurance companies globally. So you can all imagine this kind of net to sort through. I think mutualization of risk beyond geographical, political boundaries. The world has got a lot smaller with the internet, but insurance hasn't kept track with that as a service, because essentially it's a promise if something happens to you. My sort of vision is a much leaner, decentralized risk financing structure, basically dissolving that middle layer that doesn't really add a lot of value. By doing that, you can redistribute that value elsewhere. So there is some really healthy disruption emerging. There are some good projects, there are some not so good projects. I've labeled 3. Obviously my project is the best one, but I've labeled 3 that I'm following quite closely. I'd encourage everybody else to get involved with them, because technologists and finance needs to work a lot closer together. I can share some of my own experiences in my journey. So Nexus Mutual is trying to mutualize risk on the Ethereum blockchain. It's still quite new, but it's that concept of mutual risk sharing. I encourage you to look them up. I won't endorse them too much or explain too much about their project, because there's a lot of information available on their website. You also have one that both Sergey and I are quite keen on, is Teambrella. I think they're really trying to take it in a very different way. Disruption in a very different way, very decentralized, very neutral, risk sharing, to the concept of, I said to you about removing some of the layers. I think they're full on trying to remove the whole, redesign the whole process, and I really think that's quite a cool project to be part of. It's essentially more like a voting system. If you have an accident, you pledge your money, and then you collect a vote in a way to repair somebody. You make an estimation of the damage if you crash your car. I think that's great for very simple claims, but if it's complex, that needs to be addressed. PIP Rate is a Dublin-based blockchain startup with a proof of concept that's happened. Stanislav is a good friend of mine. He used to work in the same industry at the same level on sort of macro structured finance. And it's around data provenance, the PIP Rate project. This is, again, moving information to participants. Stan is a little bit more traditionalist in his view, but he's working more on actually getting data and giving people ownership through the data. He gave me the very good saying, which I pass on to others. It's the peasant and the scribe. The peasant doesn't often know the value of his goods, whereas the scribe, because he can understand the market, has a more competitive advantage. So we're hoping to break that barrier down. So I'd like to just briefly run through my project. It's not a promotional project. I just want people to get an understanding that I've been working in this area for almost 20 years, and I think with the right people around, we can make a real big difference. So I'll show you some of the insights of our project. I've got a couple of simplistic examples of how I go about pricing some risk, and we developed an Ethereum-based demonstration, which I can kind of share with you. There's videos within the slides for future reference. I've explored a lot of blockchains over the last 18 months, and my professional and personal conclusion is I think that a bit more time is needed to fully understand the capability of it. So from a commercial standpoint, as a startup, you don't have a lot of budget to research so much. So we plan to be a little bit more on the open source front to encourage people to come in, contribute to the overall goal. Unfortunately, there's no sound here. But what I'm thinking.
Using blockchain technology, we reduce process costs and admin fees, resulting in safe, direct, personal cover that rewards the user. Babel cover. Let's make things clear.
So, what I'd like to be able to do is, as a consumer, give you a choice on where you invest your assets, because at the moment, when you buy an insurance product, that goes off into the bank. And as a customer, you don't have any transparency in it. So I'd like to give our customers a choice to align their investments with the UN Sustainability Development Goals, so it becomes a sustainable environment. I'm not, as we would say, a tree hugger for the environment, but I think there's a lot of things about sustainable investment, impact investing, the use of natural capital that's really, in the next while, is going to be very important. Secure. Obviously, blockchain technology offers you a higher level of security in comparison to traditional databases. It's not as susceptible to corruption as in relational database technology, and particularly if you're scaling across boundaries and using high volumes of data, and then you need the data to be reliable. As I say, fully transparent. That's our emotion, if you like, or our honesty in the system. You'll be able to granularly see every single euro, dollar, yen, whatever currency you're buying in full detail. Incentivized. What I mean by this is it's you buy insurance, you never see that money back again in the form of a reward. You can't put risk behavior into the product. If you could make people drive better, if you could make people, be a better citizen, you can make people be more sustainable, you don't, incur natural catastrophe, you reduce that. But then what do you do with that money? And I think this is a challenge for the crypto industry, because virtual rewards or virtual currencies have a very interesting place to play of being able to convert what's an intangible asset. At the moment, an insurance policy, into something that you can use every day. Technology, I'm following a lot in the smartwatch field, Fitbit Pay, Garmin Pay, Apple Pay. So I'm pretty excited once that comes on board to be able to put that into a product that people can use. From a health standpoint, a lot of the technology in the watch is now monitoring people's health. So you can reward people for, going out for a jog or keeping healthy. You can collect that data then to be able to validate the reward. So I thought it's interesting. I won't spend so much time on these, but I just wanted to give you two examples: personal risk and how you begin to kind of start thinking about pricing that. It's very simple. But what I like to use is imagine this big lump of clay or putty that has no shape to it, and that's what kind of thousands and thousands of clay and data kind of is presented to itself. So as a technician, you don't really know where to start. You don't really know what the levels of risk retention or transfer are. So I'll give you a couple of slides here that is just a very sort of rule of thumb basis. So you start with a data list, and this is an example of, I think, around 3,000 motor claims. On the far left, you begin to sort of get your data tags, I guess, that you can start working with. Loss of the date loss, the year. These are all important factors when you start trying to do simulations to project out sensitivity. So there's 3 years worth of data in this set. The gross incurred is the actual sort of final settlement claim. The amount that you get back is not necessarily the same because you may not see the costs that are incurred in that claim. That's from the insurer's perspective. So this could be 40% of that is a claims handler fee. You may only get a fraction of that. So we start by looking at that data set by saying, well, how's that kind of structured? You may not be able to see, but there's a couple of outliers here, like the 1.5 million level. But you can see the majority is below the sort of 10,000 level. And what we do with that now is we know where to zone in. We know we probably don't want to take on the exposure of a 1.7 or 1.5 million claim. So what we do is we take that bunch, the 10,000, where the highest frequency, the lowest severity, and we start working around with that. And what you can see here then is if you sort the data by highest value to lowest value, you can see that a strong proportion of the cost is in the very few claims. So again, you begin to start working these layers. And in the current model, those layers are then placed in different parts of the ecosystem. I believe through blockchain technology, we can sort of remove some of those layers by connecting this information straight to the capital. So we then look at the 10,000 level. And you can see it's quite, so you've got this band in the middle, which is about 2.5, maybe to 5,000 each claim. So what does that mean? It means that when you start looking at the fleet exposure, so if we say this particular example, we have 18,000 cars, over 3 years you multiply that by 3 and we have almost 2,500 claims within that. And you come up with a frequency. And so on a simple average basis, you take that 10,000 claim level, I think it represents about 3 million of the overall total here, and you divide one into the other, you get like a baseline premium that you should charge everybody in that 18,000 pool. And in this example, it works out to be about 57. If you were to take the full risk, you have to obviously accommodate that 1 in every X thousand amount of claims, it could be 1.5 million, and then redistribute that round. Or you simply cap out your risk and then throw that to somebody else who's got a higher appetite for such a level of risk. Again, that's the current trend, but what I'd like to do is be able to connect those trigger points to be able to connect the capital a lot quicker. So we've done a lot of work over the last year. I've worked with some of the best technologists. I don't admit to understanding much of it because I'm a practitioner, but I'm hugely interested. I think if you're starting up, it's important about the team behind you, and particularly on the technology side. So there's a demonstration video here of our app, but I won't show you that because it's 11 minutes. I did the voiceover for the demo because Richard Depadio was busy at that time. He wasn't available, so I did that. And then I've also attached a 25-minute Ethereum blockchain-based demonstration for people to view after. And this is actually saying, you know, what is the current status and what's the future? And the future is that everybody works off the same information. So there's two reinsurers in there, and a person buying a policy, different risk data characteristics. Again, I did the voiceover for that. Hello. There's a buy process, a claims process within that demonstration. And that kind of concludes my talk. I'm around for the rest of the night. Go back tomorrow. And I think the message for me is sort of digitized, democratized, and decentralized. I think the powerful thing that we have at the moment is in past periods of enlightenment, if you like to call it that, people weren't aware they were living in it. In the internet age now, we're actually acutely aware of the era we're living in. I think it's up to us to take that opportunity, different views on different things, and I'd be happy to share that. So thank you very much. Thank you, Dave.